Good day, boys and girls. Now we have learned about salaries and wages, and the salary and the wages journal and the posting to the ledger. But the entries in the CPJ that you've done up to now for salaries and wages have to be updated with the new knowledge. Today we're going to look at how the entries will look in the cash payment journal. Now, the amounts owed to the salary earners for salaries and to the various institutions for deductions and employers' contributions must be paid either at the end of the month or at the beginning of the following month. These payments are recorded in the cash payment journal and are then posted to the general ledger. So we will use the information from the previous example that when we used the salary journal to show the relevant entries in the cash payment journal of Lango Traders. Assume that Lango Traders pays the amounts owing to its employees, AB Pension Fund and the CD Medical Aid, SARS and the UIF by check at the end of the month. So in the CPJ, we will not write each check individually. We will say check number 931 to 933. And then in the details, we do not name our employees individually. We will just say individually. And the total amount that we paid, that is now the net wage. Now, because what do we owe the employee? The net wage is then paid to them. And remember, the account in the general ledger that we now use to show the net wage is net salary is creditors for salary. So our reason for making the payment is going to be creditors for salaries. Then we will mark out the AB pension fund, 729. That will now be the deduction plus the contribution. And the ledger account is the pension fund. Then we also will make out our next check for CD Medical Aid. And the ledger account is medical aid. And the same with SARS. That is the pay as you earn, but very importantly, the account name in the ledger is SARS pay as you earn. We have now already dealt with VAT. VAT is a different tax than SARS. So the business will pay over VAT. So there will be an account for SARS VAT and then a separate account SARS pay as you earn. So the pay as you earn part that goes with SARS is very important. It needs to be with the name. And then lastly, the UIF, which is now also the deduction and the contribution. So these payments is now shown in the cash payment journal and it needs to be posted to the ledger. Now remember, when we post from the cash payment journal, our basic rule is whenever we pay money, bank is going to be credited and our reason for payment is going to be debited. So each of these accounts is going to be debited. What effect will these have on the accounting equation? We pay, which means our bank asset decreases. All of these are liabilities, and that means our liabilities is going to decrease with each one of these payments. But the wages will be, salaries will be done at the end of each month. Wages are paid at the end of each week. So at the end of each week, the payments will be made. Each wage earner is then given an envelope containing his wages in cash. Because one check is used to pay the week's wages, only the amount is entered in the CPJ. This payment is usually recorded in a separate column in the CPJ for creditors for wages. Because it happens more than once during the year, there will be a column in the CPJ for creditors for wages. Lango Traders cashes check number 908 for 1,430 to pay wages for the week ended 27 January 2016. So in the entry will be the check number, day, the check will be for cash because we cashed it, the total amount, and in the column for creditors for wages, the wages will go. The same applied to the salary, applied to the wages. The deductions and the contributions will be posted to the ledger, and then at the end of the month, the payment will be made. Income tax calculations. Employees are obliged to deduct income tax paid as you earn from the salaries and wages of their employees. This is calculated using income tax table, which sets out the amount of tax payable per annum based on a percentage of the income earned during the tax year. The tax year starts on the 1st of March and ends at the 28th of February. The income tax table is adjusted each year when the national budget is reviewed. For our purposes, we will use the income tax table for the tax year ending 29 February 2012. So that is the tax table. For any income between 0 and 150,000, that is now per year, you will pay 18% of each R1. And then from 150,001 to 235, you will pay 27,000 plus 25% of an amount above the difference between your annual salary and the 150, and the same goes then on to the others. The following tax rebates are granted for the year of assessment ending 29 February 2012. The primary rebate, 10,755. Secondary rebate for persons 65 and older is 6,012. And a tertiary rebate for persons 75 and older is 2,000. The first column of the income tax table sets out the taxable income bracket. So that is the income bracket that you have. A person who receives a salary of 15,000 per month will earn taxable income of 180,000 per annum, and thus be in the second tax bracket between 150,001 and 235,000. The second column sets out the rates of tax. A person who earns 180,000 per annum is liable for a tax of 27,000 plus 25% of the amount above the 150 before rebates. So it will look like this. So the tax before rebates is the 27 plus 25 with the amount above 150. So that means we need to get the difference between the year annual income, 180 plus 150 minus 150. So 25% of 30%. So it is 27,000 plus 7,500. So the tax before rebates is 34,500. To work out how much tax the person must pay, the rebate is subtracted from the above amount. For persons under 65 old, the rebate for the 2011 and 12 tax year is 10,755. A secondary rebate of 6,012 is granted for persons 65 years and older, and a tertiary rebate of 2,000 is granted for persons 75 and older. So assuming the person in our example is under 65 years old, the tax liability for the year will be 34,000 minus the 10,755, and that is then 23,745. Now you can calculate the monthly pay as your earn deduction by taking that amount and divide it by 12, and that then gives us the pay as you earn per month. So, Tobin Becky is 46 years old and earns a gross salary of 22,500 per month. Calculate his tax liability for the year ending 29 February 2012. There's our tax table and the rebates. So first we need to calculate his annual salary. So that will be 22,500 times 12. So his annual salary is 270. So if we look at the table there, his taxable income falls under the bracket of 235,001 to 325,000. So the tax before rebates is then 48,250 plus 30% of the amount above 235,000. So we need to get the difference between his income, which is 270 and 235, and we need to calculate 3% of that. So it's 30% of 35,000, which is then 10,500, added to the 48,250, give a total tax before rebates of 58,750. And since he's 46 years old, he's entitled to a primary rebate of 10,755. So subtract that from his tax, means the tax liability, the tax that he owes for the year is 47,995. So per month, remember, you deduct per month, you need to divide that by 12 to get his pay as you earn for the